In the intricate world of international finance, understanding the dynamics of carry strategies across different maturities of bonds is crucial. Today, we explore a strategy involving taking short-term positions in long-term bonds, whose profitability emerges distinctly across varying macroeconomic landscapes. While short-term bond strategies have been extensively studied, our focus shifts to long-term bonds and their connection with the international distribution of macroeconomic risks. This analysis reveals how exposure to global growth and inflation risks across countries shapes the excess returns on these strategies. Our empirical journey begins with a deep dive into the slope carry strategy. At the start of each month, we sort countries based on the slope of their respective yield curves. This sorting is pivotal. It determines our investment positions for the coming month. For countries with relatively flat or downward-sloping yield curves, indicative of minimal difference between short and long-term interest rates, we take a short position in their 10-year bonds. Conversely, for countries where the yield curve is steep, signaling a positive gap between long and short-term rates, we invest in the 10-year bonds. This strategic positioning allows us to capture the essence of the slope carry strategy, leveraging the information embedded in yield curves to seize a positive risk premium. The performance of this strategy across different periods paints a fascinating picture. Initially, the long-short spread on this strategy is slightly negative. Yet, as we move through the sample, this spread turns strongly positive and statistically significant, revealing the hidden carry return over extended periods. This transformation highlights the strategy's sensitivity to changing economic conditions, particularly before and after 2008, in response to shifts in macroeconomic risk perceptions. To explain these empirical observations, we construct an international macrofinance model, emphasizing heterogeneity in exposure to global growth and inflation shocks. This model highlights the driving forces behind the varying performances of traditional and slope carry strategies across different economic conditions. In our model, investing in the long-term bonds of countries with high global inflation exposure yields a positive excess return, primarily because these bonds are exposed to more nominal interest rate risk. Furthermore, in times of lower than average expected inflation, such as in the post-2008 sample period, countries with high exposure to global inflation tend to have lower interest rates and steeper yield curves. Equivalently, our model predicts that, post-2008, investing in the long-term bonds of countries with steep yield curves should be profitable. This prediction aligns with the empirical findings we present in our investigation. A concealed carry not only challenges conventional wisdom, but also provides a richer understanding of the intricate web of factors influencing bond market strategies. By uncovering the hidden layers of profitability in long-term bond investments, this paper sheds light on the nuanced interplay of global macroeconomic risks. For scholars and practitioners alike, our findings offer a new lens through which to view international finance strategies. As we continue to unravel the complexities of the financial markets, the insights from concealed carry pave the way for future research and innovation.